Back again, Max, investment analyst. This presentation is entitled Building the Fortress. It's about family wealth through African investment. Who I am an investment analyst. I graduated from African Leadership University with first class honors in investment and strategy. I go to the Holt Boston campus here. I study masters in management with finance. I value businesses across the world, and I've published frameworks on African investment opportunity evaluation. So I'd like to talk to you a little bit about why it's important to invest in Africa. What's the crisis, right? 3% of African family wealth survives to the second generation, and 30% is the global average. So this, to me, is a massive crisis. It means that we have an issue with wealth generation, wealth preservation, and growth, fundamentally. So, sorry, these technology things. So what makes it hard for diaspora investors in particular? Look at some of these headlines. You see Kenya shilling drops 21%, biggest drop in 30 years. Energy price surge to worsen Kenya's inflation. Thousands of Kenyans demonstrating against proposed tax increases. I was actually at those protests. So Africa, as Dr. said, has a lot of volatility. There's interest rate shifts, there's inflation, there's foreign exchange issues, policy. And diaspora investors in particular have to invest strategically to mitigate that risk. So what is the most important factor when you're thinking about investment as a diaspora investor? It is taxation, and this is the reason. If you're a diaspora investor, then you'll find that you are liable for taxes if you pay taxes from two parties, which is the Kenyan government and the US government. So this applies for both temporary residents in the US and permanent residents, as well as citizens. As you can see, there's certain options for investment in Africa. You could found a business, you could buy real estate, you could invest in other businesses through private equity, you could buy public stocks, bonds, you could even get certain deals where you invest you advise certain companies and they reward you by giving you some ownership in those companies. And as you can see across this spectrum, what this graph actually shows you is that taxes are going to significantly affect. I know you can't see it properly, but the yellow is the cost of capital, which is how much does it actually cost to run these businesses, and then the tax burden is that second part. So the white part just shows the returns, the real returns you're going to be making, and you can see that tax is a big issue. So if we actually look at a framework for navigating that tax environment, right? You look at a comparable markets framework. I'd like to give you an example via a big company in Kenya. It's called Acorn Holdings. They do the Getuba apartments. I don't know anybody who's been to Kenya of late in the last 10 years. Getuba is one of the biggest real estate developers, probably on the continent actually. They've made almost 200,000 beds, they call them. So what they did is they saw a problem in the market in residential real estate in the niche of student housing. So they saw that I've been a student in Kenya as well, and there was a big issue when it came to finding housing. And there's, as Kenya, we know Africa has a very young population, very many people needing housing when they go to university. So Acorn was getting into a very new market in 2015. So they didn't really have references. So they're getting into this market, and they're trying to discover and see if they can actually generate value, right? So if you are in Acorn's shoes, what are you looking at? You're looking at first structural indicators. You're seeing, okay, urbanization. What's the urbanization rate? What's the average rate of enrollment in universities? You're looking at certain industry penetration indicators, like what's the competition, what's the supply and demand in this market, right? Because if we know in basic rules of economics, if there's too much supply and little demand, then prices go down, right? So at the time, it was really a blue ocean. No one had really done anything. And then you can look at certain institutional quality questions, like does the government have policies and frameworks in place to protect this investment in particular? Because as we saw Dr. saying, a lot of African markets are not really developed enough yet. So they don't have these rules in place to protect you and your investments. So it's valuable to do research and find out if the right policies are in place to actually protect the investments you decide to make. So Acorn did that analysis, and they found that there was a big opportunity, and they were able to scale their business based on actually something that similar they identified in Mexico between 2008 to 2012 as well. So you can discover those opportunities if you know how to do your homework. So these are other winners. There's a company called SocoFresh. They do agricultural cold storage. There's a Victory Farms. They do large-scale agriculture in the fish sector. There's certain food processing. Agro-processing is also doing quite well right now. And you can see that the 6 common success factors across all these investments is, first of all, the right life cycle timing. So a lot of these companies are getting in at the right time, right? Before the competition really destroys those returns. They are investing in real tangible assets. That's very important because real tangible assets are much more tax efficient because there's depreciation on those assets, so it reduces your tax burden. They have anchor customers. So anchor customers are a very important concept because anchor customers simply mean these are reliable customers who can sort of guarantee those cash flows for you. So for instance, Acorn has those students. They know students must have housing, and they must pay for that housing. So that's an anchor customer example. But you can see certain like SocoFresh, the agricultural cold storage, they're servicing exporters, right? Exporters in the who are doing horticulture, for example. There's a lot of food loss. There's a lot of loss of economic value that happens, because we don't have that infrastructure. And there's a lot of food loss in the supply chain, so you can see that certain issues like that come up, and these companies solve them. So those are what anchor customers are. There's execution capability. Is there the talent in the market to actually sustain these businesses? Capital efficiency. Can you raise the capital to actually implement these things? And the tax structure. So tax is a very important thing. You need to understand how to minimize and lower your taxes as much as possible, because investments are after tax returns. So taxes are extremely important to consider. So the caveats and are that all investments, I've told you about a few sectors, yes, but every investment is really an individual case analysis. You really have to look at the price you pay. A good investment, quote unquote, can turn bad if you pay too much money for it. So it's very important to understand the price you pay, and even if it's a good asset class, you need to validate certain things like that. You would need to validate those anchor customers early enough. You would need to understand the execution risk and the regulatory environment surrounding that industry. We know certain things like affordable housing in Kenya. The government recently got involved, and that's shifted the market completely, right? So there's a lot more supply in the market. So if you're a player in that market, then it might change your entire business case, so to speak. So yeah, so let's talk about financing options as well. So you could do full equity financing, which means that you're putting up all the money. I would recommend you do something like that if you're just starting out and trying to test out the fundamentals of whatever you're investing in, the business, the unit economics. And then if you're talking about debt in Kenya, you really do understand the fundamentals of the business already. There's steady cash flows, because Kenyan debt tends to be a little bit expensive. So you need to understand those fundamental parts of your business so that you can actually raise Kenyan debt and not go under, right? So US debt is also an option where you can take loans here where rates are technically cheaper and invest that money back in Kenya. The caveat there, I would say, is that the currency, the FX, the foreign exchange risk plays a role in all African markets, especially. So if the currency depreciates faster than your investment can return, then it actually destroys your investment. So with US debt, I would recommend probably investing in industries where you're earning foreign exchange, like export-driven industries where you have good anchor customers, so that you're earning dollars from those investments. We can talk about SACCOs and cooperative financing. This is something that the Kenyan government is actually very big on. So for those who don't know, SACCOs are really sort of community finance organizations where groups of people with similar enough interests come together, pool their capital, and what they're going to do is they loan that money to the members of these SACCOs. Now, what's interesting about them tax-wise is that the Kenyan government doesn't actually tax interest on those loans, which is a big incentive because they want these organizations to keep giving capital out to businesses and individuals. And yeah, so those can also play quite a big role in how you think about financing. If you can, join one, or maybe one day the diaspora itself will have its own cooperative financing mechanism, which can actually help. But now you can also have blended debt and equity, which is usually the optimal thing. As financial analysts, every single business has an optimal capital structure between the money you put in and the money you can raise. So that it becomes the cost of capital when you aggregate it is much cheaper. So because cost of debt tends to be lower than the cost of equity. Cost of equity simply means what's the return that you should demand as an investor at a minimum for this investment to make sense given the risk that you're taking. So that is something that you do need to consider when you're thinking about investment in Africa. Now, the three main takeaways. Tax is the most significant consideration when mapping investment strategy. Real assets win because they hedge country risk and save on tax spend. And when you enter a market, determines the returns you will make. So as we've said, investing equals being a part of Africa's growth story. Thank you very much. Yeah, we'll just get